to be able just to talk up, just to take just to be able to take us through Treasury bill as a product. And yeah, so Stella does a lot of this. She's an investment consultant. I similarly do investment consultancy. But today we are going to specifically be talking about Treasury bill, and this is the second session. So I just want to welcome each and every one of you wherever you are. I know some people are not around. That is in Kenya, but I know majority of us are in Kenya. Pole sana for the baridi. I know we are all bracing very cold seasons. Yeah, but I hope that at least from today's talk, it will be it will add value in spite of the cold. And so I just want to recap what we did last time in a few minutes, just what we covered last time, so that in case someone is joining us and you are not with us last time, at least you can be able to catch up. And so last time, just a minute. Yeah, so last time we discussed treasury bills and treasury bonds. And before we discussed treasury bills and treasury bonds, we said that people invest for different reasons. Some people are investing to multiply their money as fast as possible. When they do that, they have to take risks. They have to put their money in products that are risky. Whether you put your money in a business, a biashara, where you're trading things, you're buying tomatoes from a country and bringing to the market, or whatever other way, whether you're using stock market, whether you're using Forex, these are products that give you an opportunity to multiply your money very fast, but they also carry with them risk. In other words, the money you've put into the investment product, you can lose it, or you can lose part of it, meaning you can put in 100K, and maybe at the end of the investment period, you end up with 70K or 50K, or even nothing. So those products are good for multiplying your money, but they carry risk. You said there's another category of investment products, ideal for people who are looking more of protecting the wealth they've created. Maybe they've been able to create money over time, and now they're more conservative. They don't want their capital to go down in any way. So you put in 100K, you don't want that 100K to lose. So you want to make money over and above the 100K that you're investing. When you are doing that, you're investing in products that have protected, they're safe, they're conservative, but the interest rate is not very high. Yeah. So that's about that for those products. Then, I hope, David, you can hear.
We can hear you well. Yes, we can hear you well.
Asante sana. Then finally, is what we call the income generator. Now, there are people, maybe because you want to subsidize your income, you make X amount of money, you want to make X plus maybe 5,000 plus 10,000 to meet your expenses, or you started nearing your retirement, you want to exit from formal employment, and you want to convert the wealth you've created into an income. We call this passive income. You want your money to make an income for you. So this particular person is looking for somewhere to put their money so that they can make an income. And so you say that's a different category of people. And treasury bonds will be ideal for the person who's looking to create an income. So this is not the person looking to multiply their money, not the person looking to protect their money, but a person looking to make an income from their wealth. That's where treasury bills come into play. And we contrasted treasury bills and treasury bonds. And we said the major difference between a treasury bill and a treasury bond is the period. When the government is borrowing money from the general public that they will repay within a year, it's called a treasury bill. And we said there are three types of treasury bills. There's the 91-day, 182-day, and 364. Those are the only three treasury bills that the government offers. And so the difference between that and a treasury bond is, for treasury bond is above a year. It goes from between 2 years all the way to 30 years. And so when the government is borrowing long-term for 2-5 years, maybe they are building bridges, roads, they are building factories, the kind of investment that takes more than a year to recover, they'll use a treasury bond. For treasury bill is when they're paying bills, they're paying like salaries, they're paying utilities, they use a treasury bill. So the major difference between a treasury bill and a treasury bond is a treasury bill is short term, within a year. treasury bond is long-term, beyond an year. And because treasury bill is within an year, it's not ideal for passive income because it's short-term. Within 3 months, they give you back your money. You have to make a new decision. So ideally, it's more, treasury bills are more for protecting your money. When you put in 100K, it can't go below, but ideally it doesn't give you consistent income. But treasury bonds do that, and that's why they're ideal for passive income. So quickly, a few things we said about treasury bond. Number one, the minimum investment for a treasury bond is 50,000 shillings. So you can, and then you invest in lots of 50,000 shillings. So you can either invest 50,000, 100, 150, 200. You cannot put 74 or 108. It has to be in tranches of 50K. So you either put minimum of 50 or anything in 100, 150, 200 in lots of 50. The other thing we said about treasury bond is that the tenor or the period of investing is between 2 years and 25 years. Just quickly to mention, every month the government issues bonds. So you go to the Treasury, to the CBK website and see what bonds are on offer this month. And they're usually there at the beginning of the month, so that by around mid-month, they have closed and they are doing their allocation. Like right now, they've closed for July. So you have to wait until August. So by around 5th of August, they'll have announced the treasury bonds for August. So you go, you look at them. If you're interested, you buy. And so it's released every month. Each treasury bond has different terms in terms of how long it is, in terms of that's the tenor, how long it is. Some are just for 2 years, some 5, some 10, 15, 20, all the way to 30. I've written there 25. I should have corrected. It goes all the way to 30. And then the other thing is that every bond comes with its interest rate. It's called a coupon. Coupon simply means interest rate. Then we said interest rate is calculated per year. So anytime you see an interest rate, it's per year. So I need to go. Sorry about that. Just a second. Yeah, so interest rate is calculated per year. In fact, for most investment products, interest rate is calculated per year. And so just a second, let me share again. Yes, I just made the correction of 30 and the percentages. So currently, of course, the percentage, every bond gives a different percentage rate. But in the recent almost 2 years, the interest rate has been ranging between 10% and 14%, somewhere around that. So every month, for example, the ones that they'll release in August, we don't know. They might come with an interest rate of 12, 13. It might be 1, they might be 2, they might be 3. We'll look at that shortly. Then the other thing you need to know about treasury bonds is that they attract a withholding tax. So the withholding tax is deducted at source. The withholding tax is calculated on the interest, the interest portion only. So it usually ranges between 0 and 15%. The longer the term or the tenor of the treasury bond, the lower. The ones between 25 and above, they're usually zero rated. It means that you don't pay tax and you don't even report it in your tax returns. Below that now, every bond they'll write, this is the tax rate that they're offering. And they use lower tax rates as an incentive to encourage people to invest. So for example, if they want a lot of people to invest, they can say this is zero rated. So people, of course, will be attracted by the fact that it has no tax implication. And so they'll invest more. Then we said that at the end of the term of the tenor, if it's a 2-year one, it's a 5-year one, if it's a 10-year one, the government returns the money that you originally invested. So if you invested 50,000, over the period of maybe 5 years, they'll be giving you interest that at the end of the 5 years, they'll return to you the 50,000 that you invested. Another important thing we mentioned is that treasury bonds can be traded in the secondary market. And in this case, when we say secondary market, we mean the Nairobi Securities Exchange, the NSE. So if you buy a bond today and maybe it's a 10-year bond, and after 3 years you want to sell it, you can be able to sell it. All you do is take the bond, open an account, no, transfer. You've got brokers, any of the stockbrokers. You can get all the stockbrokers from the NSE website. Go to any, those ones are the Diane Blair, the Sterling Securities, the all those, they're there, they're listed there. Kingdom Securities, there are around 20 stockbrokers. Go to any of them with your CDS that you opened with in when you are opening an account with the CBK. You'll fill in a form to allow the stockbroker to transact on your bonds. Once you do that, they are able to sell bonds before the end of the tenure. Yes. Yeah. So before I go on, let's see. Someone, Julius is asking, how has government behaved over time? Does it pay religiously, or is it's the same story of pending bills? That's a good question, Julius. For the period, since when? Since independence, but as long as far back as history has, Treasury bills, or rather the Central Bank of Kenya, is one government institution that keeps its word. In fact, they don't even tell you will pay after 6 months. If I'll show you an example, they give you the specific dates they'll pay. So if they say that they'll pay on 15th of August, you can be sure on 15th of August, you'll find the money due you in your bank account. They are very religious, actually very religious in the way they pay out interest. That is one thing you can be sure. And central bank, basically, even it's the dealing with commercial banks, anytime you're dealing with central bank keeps its word. It is very religious, and so you can be able to be sure about that. So a few extra things. We also talked about opening a bank account. I mean, how to open, and we said all you need to do is go to the Central Bank of Kenya or any other CBK agent. CBK agents are all commercial banks. You can go to any commercial bank and open, of course, subject to the rules. Different commercial banks have different rules for this, but they are all agents. Then there are other non-financial institutions like now stockbrokers. You can open through a stockbroker or a CMA certified investment advisor. But the simplest way is either go to your bank or go to Central Bank of Kenya. Those are the two easiest ways of opening an account. And it's very easy. I mentioned that if you go to CBK, for example, the one in Nairobi is just opposite Times Tower. Within a few minutes, they will have, there's no queue. There's usually no queue. Within a few minutes, you filled out. Within 2 weeks, they will have opened the account, sent to you the account details on SMS and email, and they'll even give you a mobile app where once you start buying treasury bills or bonds, it's the same account for bills and bonds. You can be able to see the bonds that you have, when they're maturing, details about the bonds and the bills that you buy. I also mentioned that for the people who are with us who are from the diaspora, if you're from the diaspora, I promised, I told you that there's a link in the Central Bank of Kenya website that you can be able to open an account with, just for the people in the diaspora. And I've posted it on the link, I mean on our chat. If you go to the chat, you're from the diaspora, I've posted a link. If you click on that link, you'll download a form and details on how to open an account if you are in the diaspora. Yeah, so so once you open an account, the next thing, of course, you want to start investing. And so what you do is on SMS, they send you treasury bills and treasury bond alerts on SMS. But at any time, you can go to the CBK website to know what's on offer. So as I mentioned, like currently there is none on offer, but beginning of August, there'll be either one or a few that they'll be issuing on offer. See the offer that if you are like the interest rate, the tenor, then you can be able to buy a treasury bond. Then once you like it, you can make an application, just fill in an application. You just send it to CBK, go there personally, fill in the form. And then they usually tell by the time, and we'll see an example, by the time it's over, I mean, by the time they're giving the prospectus, it's called a prospectus, where those details of the offer is, they'll tell you when when you need to pay the money, when you need to apply, when you need to pay the money, and when now you will receive your bonds. So all that is included in the prospectus. Yeah, so that's just the basics of investing in treasury bonds. So I want to be able to just quickly share like what's on offer, what was on offer last month actually. I think we looked at this, but I just want to share it just to be able to see. Yeah, there we go. Yeah, so what you're seeing on screen, Alan is asking, given the current treasury bills and bonds rate, do you have an indicative future curve? You mean in terms of, Alan, do you mean in terms of the future curve of the particular bonds? Or do you mean an indication of what the rates will be in the future? New issues. Sawa sawa. What you can see, maybe we can first look at what's there on the screen. This is an example of a prospectus. As I mentioned to you, you can see they don't even tell you that you'll pay every 6 months. They actually give you the dates. If you look at the left side, these are three. We actually looked at this last time. In the month of July, that's this month earlier, they had given 3 bonds. And they are there in the tenor FXD1, FXD1, and FXD1. One is for 2012, one is for 2018, 2021. Those names should not confuse you. All you need to do is look at what's in the brackets. What's in the bracket tells you how long this particular bonds will last. So the first one is lasting for 6.2 years. The second one, 11.2. The third one, 24.9 years. So if you go down there, it tells you the specific dates that they will pay the interest. 13th of September 2021, 12th of September 2021. So as I was mentioning, as soon as this date hits, you can be sure that by the end of the day, they will have put the amount of your interest in your bank account. They are very religious in that. That's why they give actual dates that they are going to put the money in there. So what's important, there's a lot of information in this prospectus, but what's important, a lot of it might not be important. What's important, number one, is how long is it? That's what you call the tenor. As you can see, and I mentioned this last time, when the government, for example, let's look at FXD1 2012-15, the one that is written 6.2 years. This particular bond was first issued in 2012. But they are reissuing because the amount of money they wanted to raise in the 2012 bond was not enough. Maybe they wanted to raise 60 billion, they were able to raise 30 billion. If they do that, they're allowed to reissue it again in future. So like this particular one is a past bond that they are reopening. It's called reopening it. Yeah. So these are 3 bonds. Only one is new, only the last one, the FXD1 of 2021. That's a new bond. Everything else is old. I'm not even sure the 2021 is new. It looks, because it's 24.9. Let me see. It could be a reissue, but the whole idea, what's important is that 6 years, it's one for 6 years, one for 11 years, one for 24 years. The next important thing is to know the interest rates they are offering. That's what you call the coupon rate. So the one of 6 years, they're issuing an interest rate of 11%. You can see over there. The one of 11.9 years, they're issuing an interest rate of 12.6. The one that is of 24.9 years, they're issuing an interest rate of 13.9. That's almost like 14%. The one of give and take 25 years. So those are the interest rates. So again, you need to see what interest rate and how long do I want to invest my money. So like 14% is quite good. Remember, you're committing your money for 25 years. But as you mentioned, you can always sell in the secondary market. So the other thing that is important is knowing the tax rate. Then you can be able to see just below those many dates, they've written taxation. And they are saying that discount interest is subject to a withholding tax at a rate of 10% for all the 3 bonds. So all these are attracting an interest rate, a withholding tax rate of 10%. Don't worry, I'll just give you an example. It might sound confusing, but once we do an example, you'll see how easy it is. So those are the most important things. Most of these other things, of course, I told you now, you see, like for this one is saying that you need to have filled in an application form and submitted it to any CBK branch by 2 p.m. Tuesday, 13th July. Again, as I said, these ones have all expired. So by 13th of July, you needed to have given in. By 14th is the auction date. That's when they review. By 15th, you know the amount, your allocation. By 15th, you know your allocation. I've been allocated X. At times, there is an over, at times, people demand more than is issued. So they might not allocate you 100%. So you need to know how much have been allocated so that you need to be able to pay by Monday of the following once you know, there, as like here, the results were out on 15th. So because they were out on 15th, tomorrow, which is 19th, every person who was allocated needs to pay the amount of money to CBK by 19th. Yeah. So that's actually here it's saying 20th. I know this might change because 20th is a public holiday. So that will be pushed to 21st. So they're saying the bond may be reopened at a future date, secondary trading in multiples, to commence on Tuesday 20th. So again, oh, sorry, this is on Monday is when you need to pay. On Tuesday is when you can sell, trade in the secondary market. But again, I mentioned most likely this means Wednesday because Tuesday is a public holiday. But of importance, all this information might not be relevant. What's important is the interest rate. That's what you should be interested in, and the taxation rate. And of course, the tenor, how long you want to invest. So it's that simple. I think I have an example here. Just a very simple example. Assuming you want to invest 100,000 shillings. Let me first see the questions here in case. Oh, so Stella is asking me to answer the questions at the end. But this actually, let me see. Yes, so this is a very simple example. So you have 100,000 shillings with yourself and you want to invest in a treasury bond. And you go to CBK website, you see that there's a treasury bond of a tenor. Again, you said tenor is the period of the bond of 10 years. It has a coupon of 12% and a withholding tax rate of 10%. Tenor 10 years, coupon 12%, withholding tax 10%. Again, I said these are the most important details. So how will this pan out? So if you invest today, that's in July, the first thing is that you will be paid 12,000 shillings an year. If you remember last time we said interest rate is paid twice a year. So they'll pay you 6,000 shillings after 6 months and another 6,000 shillings after 6 months. So that at the end of the year, they'll have paid you 12,000 shillings. Why 12,000 shillings? That is 12% of 100K. So 12% of 100K is 12,000 shillings. So after 6 months, they pay you 6K. After 6 months, they pay you 6K. But they will not pay you 6K. They will first subtract a withholding percent of 10, a withholding tax of 10%. So what is 10% of 6K is 600 shillings. So instead of paying you 6K, they'll pay you 5,400 shillings and withhold 600 bob, which they will send you a withholding tax certificate that you can use against your taxes at the end of the year. So in your bank account, they'll send you 5,400 shillings. Then they'll send you a withholding tax certificate of 600 shillings. And they'll be doing that every 6 months for the next 10 years. After 10 years, we are in 2021. In 2031, July, they will return to you your 100,000 shillings that you invested. I hope that's clear. That's a very simple example just to show you how it's calculated and to show you how to invest, basically. And I just, yeah, so in case you have a question about the calculation, I've used a very simple calculation just to help you. Now, I can see someone is saying that treasury bonds are one of the idealist ways of investing. That is very true, especially if you're dealing with passive income. I keep encouraging my clients who are retiring especially to consider treasury bond. And we're asking why. Number one, it has good interest rates. We've just seen the interest rates right now from the prospectus we've read for the July offers, and you saw that like the 25 one is giving you 14%. 14% is a good return on investment. You can't get that on real estate. You can't get that on very many products in the market today. 14% is really good. And so that's the first advantage of treasury bonds. The second thing we've just mentioned, it has guaranteed payout times and amounts. You can know the date you will receive the money, and you can be sure the money will be put in your bank account. And at the time of investing, you know the amount of money they'll put in your account, 2 years, 5 years, all the way to 25 years, depending on how long it is. So it gives you guaranteed time and amount of your payout. So that makes it predictable, and it's a good passive income. The other thing is it's secure. Last time I mentioned that when a government, any government in the world, issues a treasury bill or bond in its own currency, it is one of the safest investment product. Why? Because the government owns the currency. The government of Kenya owns Kenya shilling. And so because they own the currency, they can never default. The government will never get to a point where it doesn't have enough Kenya shillings to give, because they're the ones who print, they're the ones with authority over money. So that makes it very, very secure. Another thing we mentioned is of sale. I said you can sell, if, for example, you've bought a 20-year bond, sell it after 5 years, very easy. It usually, especially if you are willing to take market rate, you can sell within a week. So there is a very vibrant secondary market for treasury bonds, very easy to sell. And every day you can see in the results, they tell you bonds worth 100 billion were traded today. Every day there is a very vibrant market for treasury bonds, making it easy to exit and to liquidate. Again, if you are dealing, comparing it with maybe like-minded products like real estate, again, selling property, anybody knows it's not as easy. What we mentioned last time is that there is an opportunity for capital gains. In other words, like the example of of 100K, you can invest 100K at 12%. Then after 3 years, the interest rates maybe then will be at 10%. So instead of selling the bond at 100K or thereabout, you can be able to sell it at 115, 100, and you can be able to sell it at 115,000 instead of 100,000, meaning you've made a capital gain of 15K. So it gives you an opportunity when you're selling in the secondary market to make a profit. But remember, the opposite is also true. You can go to sell in the market, there's an oversupply, and you have to sell it at a but the difference is usually not much. Maybe you later sell it at 95,000 when the market is bad, or 105 when it's good. So it's not big, but yes, there's an opportunity for a capital gain. Another very, very, very important advantage of bonds, again, it's hassle-free. Compare it with any other investment product, it's made in your bank with no hassle at all. And we also mentioned that you can also sell it within 6 months, but there's a way you can just arrange your bonds so that you can be able to receive income every month. For example, if you're investing 100K, January 100K, February, March, April, May, June, just for 6 months, it means that for the rest of the term of those particular bonds, you'll be able to earn, that's how much. You said every 6 months they're paying you 6K. So you'll be able to earn 6K for as long as the bond survives. So you can arrange the bonds so that you can be able to get a monthly income from the bonds. Yeah, so that's what we mentioned last time. And today we've done the calculation. I just wanted, let's see whether we have, yeah, we have some time. I just wanted to quickly compare bonds with other products to show the value, and so that you can consider it as an investment product. I really hope from the 52 of us here, there is someone who at least attempted to open an account with CBK. If you did, I would really be happy to know that the information we are sharing is of value. Kindly share your information and experience. If you've started the process, if you've opened an account, that would really be helpful for me and Stella. So just quickly, let's see. Mm -hmm. Yeah, so I just wanted to compare it with different products. The first one I've mentioned is real estate. And most real estate products today, the best real estates are giving around 9%, 9-10%. If you build your own maybe rental properties, you can be able to make 12%. But remember, this is not guaranteed. There are months you'll go, you don't have a tenant, or you have issues with tenants. So of course, now that is a consideration you have to make comparing real estate and treasury bonds. Another thing about, of course, real estate is that there is usually maintenance, dealing with an agent. There are other implications because you're dealing with a relationship. But that's not the case with treasury bond. But on the flip side, I mentioned that treasury bond, the returns are consistent. For example, the one we saw of 25 years, if you invest 100K, you'll be earning around 6K for every 6 months for the 25 years. What happens because of inflation, prices of things go up. And when they go up, it means that the 6K you're earning today, 25 years from now, that 6K will be much less. It will be, when you consider it from today, it will probably purchase things worth 3,000 shillings today. In other words, the value keeps going down. And that's something worth considering, because with real estate, what happens is maybe after 5 years, you are charging rent of 25,000. Unamwambia mtu from next month, you'll be charging 27K. Then after another 4-5 years, unamwambia now we'll be charging 30K for your rent. So you can be able to adjust it for inflation. That's the advantage of real estate. And of course, another huge advantage of real estate is that you will own it for life, meaning that it doesn't have a tenor. You can hand it over to your children. So that's an advantage. So consider diversifying. But remember, for treasury, another advantage of treasury bond is the amount of money you're putting in. With 50,000 shillings, you cannot get any real estate. With 100, 200, you probably start being able to buy real estate when you get to a million plus, 2 million nauko. But with treasury bonds, as little as 50,000 shillings, you start having passive income. So that's a huge advantage of treasury bonds. Private equity, again, private equity, I don't want to explain private equity a lot because that's not today's conversation. But private equity simply means you own a part of a business. For example, my company is called Rubiani, or for Stella is called eagletactcltd. You can approach Stella and say, Stella, I want 10% of your business in exchange of 10% of their losses and profits. So when Stella makes money, 10% comes to you. That's a private equity. Basically, it's a business that you're not involved in running. Very ideal for passive income, but there are risks associated with it. And the private equity industry in Kenya is not so well developed. So again, comparing that with treasury bonds, the risk element. I mean, when you invest with Stella's business, you don't know whether next month, how much profit you can't predict. And business can go up, it can also go down. So again, you can lose your money through private equity. Another thing is wealth management. Wealth management is offered by fund managers. If you go to fund managers, the Britams, CICs, the Zimele, the African Alliances, all those fund managers licensed by Capital Markets Authority, they will have a wealth management, a discretionary account or something similar. They have different names. I think wealth management is CIC and Britam, if I'm not wrong, but they all have a name where they tell you, bring your money, we'll put it to work. At the end of the month or at the end of 3 months, whatever we'll have made, we'll give it to you. So again, number one, it's not predictable. Number two, it's short terms. Most of them will give you within a year. All of them will give you within a year. So they'll tell you, invest your money, you'll put it into work. Within 3 months, we'll tell you how much you've made. Again, that lack of long-term advantage of treasury bonds means that you can't use it over a long period of time. And then it also has some level of decision making. Every 3 months, you have to decide, do I need to reinvest? Do I need to move it to a different wealth management company? But remember, for treasury bond, once you agree, you fix your money in like the one we saw of 24.9 years, you forget about it unless you want to sell it, you just forget about it. They'll just be throwing money into your account. SACCOs are also a good example. Good, I must admit, SACCOs, because especially they are good SACCOs that pay a good interest at the end of the year. So it's also worth considering, and it's a good option for treasury bond. But remember, treasury bond is for many years. It's government guaranteed. Again, we've had a few issues with a few SACCOs that have not been able to meet their obligations. So the advantage of the guarantee of the government again makes treasury bonds score better. But the advantage of SACCO, on the other hand, is that you can borrow. You can't borrow, of course, against treasury bonds. But with SACCO, you can use your shares to borrow. So that's the advantage of a SACCO. Yeah, so I guess that's it. For the others like stocks and Forex, again, all those are risk products. So when you compare them with treasury bonds, again, the risk elements means the person investing in stocks and Forex is looking for they're in a different mind from the person investing in treasury bonds. The one investing in treasury bond is looking for safe guaranteed returns. You can't get that from stocks, from Forex, from all these other contemporary investment opportunities. So I guess that's just a comparison. So of course, treasury bill has its advantages and disadvantages when compared with the rest. But in my personal opinion, is that especially for a lot of us who probably are not at a point when we can invest in real estate, because maybe you see with real estate, many of us can probably just invest in one or two projects. Maybe you just have two rental houses, but then after that, now getting to the third one takes a long time. Saving up for a rental property takes a long time. For that reason, treasury bonds are really ideal, because with 50,000 shillings, it's like you have a kahao that is giving you rent every month that is guaranteed. Look at it that way. And for that reason, again, I highly recommend treasury bonds as a source of passive income for you. Yeah, so I guess that's it. Yes, so I guess I'll just go to questions. Today's session was much shorter. Stella told me to try and keep it much shorter. I kept my word. So I want to check a few questions here. Number one, to me, okay, Peter is asking, to me, treasury bonds and bills are the best investment options. They are risk-free. This is so true. But remember, investment options for people who are not willing to take risks, because there are people who want to take risks because they want to multiply their money as fast as possible. So if you want to be risk averse, yes, Peter, they are very safe. So Eva is asking, what about treasury bills? What is the interest paid? Treasury bills in the recent, like what, a month ago, before a month ago, treasury bills were paying 7% for 3 months, 8%, and that's the rate I gave you last time. 7%, 3 months, 8% for 6 months, and around almost 9 or around 9% for 1 year. But the treasury bill rates have gone down in the last 1 week, actually. In the last, let's say 2 weeks, between 1 and 2 weeks. If you go and check the treasury bill rates, they've really gone down. The 3 months one is actually 5%, which is very low. The 6 months one is around 6 point something. And the 1 year one, I think is around 7. They've really come down. Again, a reflection of the liquidity in the market. There's a lot of liquidity in the market. So the treasury bills have really come down. You need to know that in the last 1 week, that has changed from what I gave you last time. So again, treasury bill rates, you can check them in the central bank website. But it's really come down in the last 1 week. So it's around 5, 6, 7 for 3, 6, and 1 year. So it's much lower than the treasury bonds. Again, you can see treasury bonds are giving as high as 14%. So definitely a better option. But remember, the one investing in treasury bond, long term. One investing in treasury bill, short term. So Eva is asking what, okay, sorry, Freedom Charo. Frida, I hope I am not so, I know a Freedom Charo. I don't know whether that's you. But Frida is asking, what's the difference between buying a bond through central bank and through an insurance company? Now, number one is that treasury bonds are not sold by insurance companies. And I don't know what particularly you're comparing with what is issued by insurance company. So what is issued by insurance company perhaps is a corporate bond. A company can offer a bond the same way the government offers a bond. Like currently we have a Britam bond. So that Britam bond works similar to a government bond, but it's not issued by the government. So you need to know that the issuer is Britam. If Britam comes down, your money disappears. So there's a risk. Also, of course, it's not coming down, and don't misquote me. I'm just saying whichever company is issuing a bond, there is a risk associated with the fact that it's a company and anything can happen to the company and it's not able to meet its obligation. The other products by the insurance companies are, for example, their life insurance products. Of course, they can't be compared with the treasury bond. The only a comparison is that they are long-term. The products are 15, 20, 25 years. They carry with them life insurance, but the returns are substantively lower than treasury bonds. If you calculate the returns on a life insurance long-term product, what they call endowment policy, you'll see that the returns are substantively low than a treasury bond. But remember, when you're putting your money there, it's more of the life insurance. For example, an education policy. An education policy is a life insurance. You are taking it so that in case anything happens to you, your child's school fees will be paid. So again, the person putting the money there is putting it for a different reason from the one putting in treasury bond. Different products, different purposes. It's important to know that. So I'm trying to see what you could be meaning, Frida, when you're saying what is issued through insurance companies. So treasury bonds are only issued from central bank unless it's a corporate bond. So I hope I've answered you, Frida. Someone is just,
Can I
yes,
respond?
yes.
Like I know at Britam,
yes,
they have an option where a client can invest in bonds and treasury bills. So the company invests for them. So that's what I was asking. What's the advantage of, say, investing through a company like Britam, or just wait for me to do it for myself?
That's a very good question. Now I've understood you. So what companies, they don't do it as insurance companies. They do it as what you call fund managers. So like Britam asset managers, CIC asset managers, most of them have insurance associated with them. But what they do is they do what are called mutual funds, where they collect money from different people and, for example, invest in a bond. So it's called a bond fund. So basically what these fund managers, let's take an example of Britam asset managers. They have what is called a bond fund. So they pull money, that's a mutual fund. They pull money from different people and then invest it in bonds. Is that good? Yes, it's very good. And I think we had a different session some time ago where we talked about different products and we talked about the bond fund. So a bond fund is a mutual fund that is issued by fund managers like Britam, like CIC. But remember, not the insurance side, it's the asset management side. So like Britam has Britam Asset Management. So they have what is called a bond fund. The difference between entering directly to treasury bonds and going through a bond fund is that, number one, Britam will expose you to different bonds, not just treasury bonds, but corporate bonds, and not just one bond. They have been investing, like now, every month, Britam is investing in new bonds. Like now, the ones we've just read, most likely Britam invested, the ones of August, September. So by the time you are buying or putting your money in a bond fund with Britam, by the way, the bond fund is also called the income fund or the high yield fund. Different companies will call it differently, but it means the same thing. It's a bond fund. So the advantage is that they expose you to a larger array of bonds. But the thing is that at the end of the day, if you look at most bond funds today, even when you go to the newspaper, they'll report their bond funds. Like Britain will report, most bond funds are doing around how much? Around 8 to 9%. Again, you see the advantage of going directly to central bank, you're already getting 14%. Yeah, so if you ask me, if you want to invest in bonds, look at the interest rate. Go to Britam, ask them, how much are you issuing me on the bond fund? Of course, they'll tell you they calculate the rate daily. So even if you go to the newspaper, you can be able to see they're giving around, I think around 8 and 9%. 9 is giving over 10. Maybe I'm not so sure about, there are some, the Cytons and the Amana Capital, they could be giving higher. But for the more common ones, the CIC, Britam, the, the larger funds, let me call them the larger funds. The larger funds are giving below 10%. And in that case, it is more advantageous for you to go directly to central bank when the rates are higher. Of course, a huge advantage of bond fund, you can enter anytime, leave anytime. So you can buy a bond fund, you can put your money in a bond fund with Britam today, and within 4 months, you're able to sell. You don't need to go to secondary market or anything. You just give an instruction to Britam. Within, I think, 2 days, 2 working days, they're able to give you the money. So the liquidity is much easier with a bond fund as compared to bond. I hope I've answered your question, Frida.
Yes, you have. Thank you.
Great, great. So let's see the other questions. Let me stop sharing. Um, sorry. Let me go to questions. Yes, here. What if I have a Cisco account with a broker, say Dye and Blair? Can I use the same account to trade in treasury bills and treasury bonds? I talked about this last time. It's a CDS account, not Cisco, but the CDS account, the account you open with Dye and Blair is for stocks. The one for treasury bill is a totally different account. They have the same CDS name, but one of them is called the stockbroker CDS. The other one is called the central bank CDS. They are two different ones. So you can't trade on either. So if you have one in Dye and Blair, you can only trade with it for stocks. When you want to deal with treasury bills and treasury bond, you have to open a CDS, a CBK CDSC. So it's CDS simply means central depository. It's just an automated account. It's an E account, let me call it that way. So the E account that deals with stocks is different from the E account that deals with treasury bills and bonds. You need to open a different account. Joshua is asking, is it possible to buy another treasury bond if you have an existing treasury bond? Yes, you can buy a new bond every month. You can buy like now there are 3 bonds that were on offer in July. You could have bought the 3 of them. You can keep buying as many bonds as you want. There's no if you bought another one, buy another one and another one and keep buying. And that's what we are saying. You can accumulate over time. You can say every month or every 3 months, I'll be buying a bond. Within 2 years, you have almost 12, 13 bonds. And now you start seeing substantive passive income coming your way. Stella is asking, please expound, if I have 6 million, how should I invest in treasury bond in order to enjoy monthly income? So yes, so I gave the example where I said, if you put in 6 million, let's use an example, maybe you can share that. Um, and this is, I have clients who do this a lot. So this is a good way of planning yourself so that you can have income every month. So if you have 6 million, and let's assume for our calculation basis, we say that the bond is the same. So let me share this. Um, yeah, so it's the same bond that is 12%, and then 6. Yeah, so it's same 12%, 10 of 10 years. In July, instead of if you invest all this in July, it means that per month for 6 million, you'll get 600,000. So that means 300,000 after 6 months, another 300K. After 6 months, another 300K. So Stella is asking, is it possible instead of making 300K every what's 12% of it? No, it's actually, sorry about that. For 12% of 6 million is actually uh, I think 720,000 shillings. I'm sorry, it's not 600. It's 720,000 shillings. It means every half you're getting 360K. You're making 360K every half month. Every 6 months, you basically if you invested 6 million in this particular bond that is issuing 12%, you'll be making 720,000 per year, which translates to 360,000 shillings per month. So, I mean, per 6 months. So Stella is asking, is there a way I can arrange these bonds so that I get like a salary every month? I'm getting money. And what I mentioned is that if for this particular bond, you put in 1,000,000 shillings in January, it means 12% of 1,000,000 shillings is what? 12% per year.
21.
Someone is helping me. Hesabu imekuwa ngumu.
120.
120K, yeah, per year. Perfect. So if I invested in July, it means July, August, September, October, November, December. In January, I'll be paid every January, and July I'll be receiving 60,000 shillings, which is half of 120. I hope that is clear. I hope everyone is following on how we are calculating. So basically, they are paying 60K every January and July for the 10 years. So what we are saying is, if we do that, if again in August we put in another 100K. Remember, we have 6 million. So we are saying in July you've put in $1 million. In August, if you put in $1 million, it means they'll pay you in February of next year and August. That is 60,000 shillings. So we do that for the other one. As you can see, January and July, you'll be earning 60K. February and August, you'll be earning 60,000 shillings. But I guess, let's just complete now that you've started. So, so basically what we are saying is that ideally, of course, you might not get the same bond every month, but if you invested in July 1 million, in January of 2022 and in July of 2022, CBK will pay 60K to you, so that at the end of that year you'll have made your 120,000 shillings, which is 12% of a million. So again, instead of putting the whole 6 million in July, put it in July, August, September, October, November, and December. So if you just put in money between July and December, that will come up to 6 million. Then for the rest of, let's say, 10 years or 15 years or 20 years, depending on the tenor of the bonds that you're buying, you'll be receiving 60,000 shillings every month. It's like a salary. So you've invested 6 million in 1 million chunks for 6 months. You'll be earning, and I hope you've understood. So in January, you earn 60, July 60, February, March, April, May. So by the time you get to June, you'll discover that the whole year is covered, because every month you're receiving, for every investment, you're receiving every 6 months. And that's something that I've done with quite a number of my clients. The clients who want to convert their money or their wealth into a salary that they can receive every month. So we are able to say you have, it doesn't need to be 6 million. Maybe you have 300 million. We divide it into 6 chunks. And for 6 months, we look for good bonds that will pay a high return on your investment. That way, after the 6 months, they will be earning a consistent amount of money for the duration of the term. So if it's a 25-year or a 30-year bond, for the next 30 years, they'll be earning 60K. And I just want to mention, look, if you're investing 6 million, it means you are receiving 60,000 shillings a month at 12% interest per year. That is a very good return on your investment, because just to compare it, if you're buying a real estate property of 6 million today, for example, somewhere within Nairobi, it's very hard for you to earn 60K per month on that property. Most of the times, the properties you are buying at 6 million is a 2-bedroom house that will earn you around 25K, 30K max. So again, you can see the treasury bond is giving you a substantive return for a long period of time. You're talking 30 years, that is stress-free. So I just wanted to compare that and just to answer Stella. And I can see that has brought in quite a number of questions. Let's see. Yeah, so Stella is asking, so Julius is asking, insurance also has a product called money market fund. Yes, bond fund, money market fund, equity fund, there are even real estate investment trusts. All those are what you call mutual funds. They also have another name called unit trusts, and they are issued by, not by insurance company, but by sister company owned by insurance company called asset managers. So all those insurance company have what they call an asset management wing. So they sell money market fund. I think we talked about money market in one of our previous conversation. And money market is yet another product that I highly recommend, especially for your every month investing. For example, you are not yet at 50K. If you have 1,000, 2,000 bob, money market is really ideal. It's not a conversation we can hold today, maybe in future. But yes, Julius, you're right that the money market product is an alternative. But okay, now you need to understand, because it might not be long term, it might not give you passive. So again, for the reason you're investing, money market is quite ideal. Another question: if I purchase bonds via CBK interest, I still earn 14% interest rate? Yes, because you're buying from the agent. The agent is not the one who will pay you your interest rate. All you're doing is applying through an agent. Your interest still comes from CBK to your bank account directly and not through your agent. So if you go to, for example, a stockbroker and open an account and buy treasury bonds through the stockbroker, your money will not come from the stockbroker. It will come directly from CBK at the rate that was indicated in the prospectus. So just to answer you, the rate is the same and it comes directly from CBK into your bank account. The only thing is that the agent gets a commission from CBK from selling. So they are simply a sales agent. They don't handle the investment in any way. Julius is asking, at maturity, will you get back the invested amount? Yes. If you invested 6 million for 10 years, at the end of 10 years, central bank will return the 6 million you invested. If you invested a million, they'll return the 1 million. They'll return exactly the amount of money you invested with them. So that's true, Julius. You will get your money back. Josh is asking, 60 million, if you remove 10%, comes to 50K. You're removing 10% of the 60,000. So that's a good point he's raising. He's saying you won't receive 60,000 into your bank account. The withholding tax is 10% of the 60K. 10% of the 60K is 6,000 shillings. So what will come into your bank account is 54. Oh yes, I can see you have revised that. And you're right, Josh. It's important to note that the tax is withheld at source. In other words, central bank withholds it. They send 54,000 shillings to your bank account and send you a withholding tax certificate of 6,000 shillings that you can claim at the end of the year against your tax liability. Whatever tax you are supposed to pay, when you calculate, you just deduct the total amount that they've been withholding over time. Alligator is asking, bonds are tax-free, right? No, not all of them. Some are tax-free, only the long ones are tax-free. All the other bonds, you have to pay tax for the interest. Remember, interest is an income you're making. So you pay tax against that income of the interest. So like now we are saying the 60,000 shillings, you need to pay tax. So what happens is at the end of the year, you need to say, I have earned a total of, for example, in our case, 60,000 shillings times 12, that's 20,000 shillings. Are meant to pay X amount depending on the tax rate for that year. So maybe out of that 72,000 shillings, you need to have paid maybe, of course, maybe if you're removing other expenses, you can remove other expenses. Then maybe the amount of tax you're meant to pay is, say, 100K, and maybe the total, okay, they've been withholding 6,000 shillings a month, remember? So in a year, they'll have withhold 72,000 shillings. So you'd subtract 72,000 shillings from what you're meant to, and you pay the difference. Of course, most of the times, the amount for most people, at least the ones I know, is that the withholding tax covers for all their tax, because they have other expenses that they deduct from the amount of money they are making. So it's not tax free, it is taxed. Yeah, Stella has given her number for anyone needing more information. Josh, what is the 10% for? Are they taxing you? Yes, there's a withholding tax of 10%. We talked about that. And so Josh is actually right. They'll not pay you 60K, they'll pay you 54K. From what I understand, treasury bonds are free when the term is long. Yes, you're right. Treasury bills are free for longer term, like the ones which are over 25 years will more often than not be zero tax rated. But that is not a rule. you need to look at the prospectus of the Treasury, like the one we saw. You saw like the one we looked at. It was saying the bonds are attracting a 10% withholding tax. So you need to look at the prospectus and see the ones that are zero rated. And they are there, they keep coming up. The ones they'll tell you this is a zero tax rated Treasury bond. It means that it attracts no taxes, and even at the end of the year, you will not report it. So that's important to note. Pauline is asking, are bonds transferable? Yes, you can. Okay, can my children continue to receive the interest in case of demise? That's okay. That's not transferring of bonds. You're just giving a benefit, because you see when you're opening the account, just like any other account, you give a list of beneficiaries. Of course, it can be contested. I don't want to go into details of that, but the whole idea is that in case of your demise, the people who you have put as your what are they called? Not next of kin. Um, yeah, that name.
Beneficiaries. They are
Beneficiaries.
beneficiaries.
Thank you. Yes, yes. The people who are your beneficiaries that you indicated, they can come and give the death certificate, and they'll have the interest now coming directly to them. So that, of course, there's a process, the normal process of transfer of documents will apply for treasury bonds, just like any other asset. So if there's a contest that can be contested, the only one that can't be contested is insurance payout. But bonds, you can say that these are my guarantors. In very rare cases, they can be contested, but I don't want to go into details. I think the most important things is that bonds, the income from bonds can be transferred to your beneficiary in case of death, and you have already selected your children as your beneficiaries when you're opening the account. Coach Roy, habari ya Coach Roy, a friend of mine, is telling me good insights. Asante sana, Coach Roy. Frederick is saying, is there an option of compounding the interest in case I don't want to receive interest now? Frederick, that's a good question. The only way you can compound is through another account, not through the treasury bond. The treasury bond, as I've mentioned, every time your interest is due, they transfer money into your bank account. They don't withhold money, they don't compound it. So the way you can do it, Frederick, is now remove the money and put it in the interest and put it in another account that compounds, like a money market, but not through treasury bonds. I hope that is clear. So you can't compound through treasury bonds, but you can use a secondary product to be able to compound your money. For example, a money market is an ideal way of, if you don't want to cool out the interest, remember we said it's for passive income, but some people don't want the passive income. So you can remove the money, put it in another product like wealth management, like money market, or like bond fund, or other ones that you can be able to invest in. So Francis saying, I may understand. Someone is raising their hand. You can go ahead and ask.
Yeah, that is Pauline. Pauline is raising her hand.
Hi, Pauline.
How are you?
Fine, fine.
After this session, I just wanted to know whether you will give the contact and we can contact you for any, yeah.
Thank you, Pauline.
For
yes.
any info that you may require.
Yeah. Yes, you can contact me or Stella. Stella, have you given in your contacts?
Yes, I have.
Stella's contacts, I think. I have Stella's contacts.
So you can contact Stella. I'll also give my contacts there. Yes, any other question? I think we are winding up. Actually, we need to be winding up. So my telephone, I'll just give my telephone and my email. Any other question before we conclude? I think that's the last one, and I can give it over to Stella as I put in my contacts on the chat. Stella, unaweza